Every investor should have a watch list of companies that they want to buy if the price is right or if operations move in the right direction for one way or another. So I'm going to go through 5 stocks that are on my watch list right now. I don't own any of these stocks, but if we get a little bit better price, if maybe we get a really good quarter, that could change. So I'm going to tell you exactly what I like about these companies and why I haven't yet pulled the trigger on buying these stocks. If you want to know every single stock that I am buying every month, check out Asymmetric Investing. There's a link on the screen and a link in the show notes. That newsletter has even more depth on my research and also my stock buys every single month. I got a market beating portfolio there that I started from zero, so doing everything transparently. So I'll show you exactly what I'm doing with my money. I'm also going to use Fiscal AI to help me out here today. And this is a huge couple of days for Fiscal AI. They are offering 30% off for everybody who tries Fiscal AI right now. Go to fiscal.ai/ASYM to get that deal. This is a platform I use constantly to do research. It's got all the market data you need, income statements, balance sheets, cash flow statements. But the real differentiator they have is all these key performance indicators. They're pulling these from SEC statements. And you can see here that their charting just makes it super simple to be able to look at exactly what the trends are in a company. So look at a company like Garmin. Where are they generating their revenue? Well, you got these 5 categories. You can see which one's growing, what's their growth rate over the last 10 years. On top of that, everything you need in the investor relations page. You don't even need to go to those pages anymore. You have transcripts. The earnings reports are right here. Even their quarterly slide decks. We can just hit one button and go full screen. See everything that you want with a company. It makes research so easy. You can even follow analyst estimates over time if that's something that you follow as well. So check out fiscal.ai/ASYM. This is a product that I pay for. And this was the kind of deal that I jumped on when it came out. 30% off. You're not going to get a better deal from them throughout the year. So if this is something you've been looking at, now is the time to do it. So let's get to these 5 stocks on my watch list. One of them is the Trade Desk. Now, the Trade Desk has really become an unpopular name, but if you look at their history, they've actually got compounding revenue and they do continue to grow quarter after quarter. The question is going to be, how much are they going to grow in the future? But the reason that I think this has become compelling is the valuation. Look at this drawdown that we've got in the stock. You can click down to drawdowns here, 72% from its high. And that was a little over a year ago that was less than a year ago that they hit that high. That is an incredible pullback in the stock. So look at the valuation here. You can see enterprise value about $18 billion. Enterprise value to sales is about 6. Not too bad for a technology company. On a forward basis, you look at price to earnings multiple is about 20. That looks pretty inexpensive for a company that has grown their revenue 24% on a 3-year compound annual growth basis, 30% on a 5-year. Price to free cash flow is about 20. So when I look for asymmetric opportunities, I'm looking for companies that have a relatively good valuation and where the upside potential is going to be maybe they grow revenue faster than analysts and the upside potential is going to be maybe they grow revenue faster than a lot of investors think. They're able to compound that revenue over a long period of time. A lot of times the time horizon of investors is really only a couple of quarters, but I'm thinking about 5, 10, 15 years. What is the market going to look then? Is it going to be much bigger than analysts can actually build into their models? Are those margins going to grow faster? And is there an opportunity for multiple expansion? So I think you have all 3 of those things that could play into asymmetric potential for the Trade Desk. So let's look at some of the high level numbers. This is revenue is the blue column, and then the orange line is the revenue growth rate. So you can see from a relatively small base, the growth rate was higher a few years ago, 100%, over 50%. But it is 21% over the past 12 months. That's a really solid growth rate. So you can see this compounding in the business. These numbers go all the way back to 2014. On this enterprise version of Fiscal AI, you get up to 20 years worth of data. But this is as far back as the Trade Desk has published. But let's look at some of the quarterly numbers. And here's where you can see where there's a little bit of worry in the market. And you can see that the growth rate has kind of gone down a little bit over the past couple of quarters. So 19% in the second quarter, third quarter, 18%. The real question becomes, are other companies taking market share from the Trade Desk? Amazon would be the elephant in the room there because they are really growing that advertising business. And this is what they want to take a bite out of. They want to have the companies that are on their platform that actually use Amazon for their advertising, whether they're going into advertising on the web or even on TV deals. That could potentially take a bite out of the buy side of the market that the Trade Desk is operating in. So that's the theory. That's the kind of bearish case for the Trade Desk. But what you do see is that they do continue to grow. This is not a company that is stagnated at this point. And I think they've gone through a number of things over the past few quarters, had some new product launches, didn't go particularly well. Customers didn't like them. They had to reverse some of that. So that can be a learning lesson. That can also be a buying opportunity for investors. And from a risk side, the trade desk's actually relatively low risk. This is the balance sheet. They got over $1 billion in cash, $1.4 billion worth, and there's no debt on the balance sheet. You can go down here, you can see current portion of long-term debt. Here's the long-term debt, nothing in these lines. They do have some leases, but most companies have leases. That is nothing really to worry about on the balance sheet. The trade desk is also generating positive cash flow. The blue line here, I'll isolate that. That's the operating cash flow coming from the business. So about $881 million over the past 12 months. And then if we look at the free cash flow, a little bit lower than that, but still a really good free cash flow number for a company like the trade desk. So I think the real opportunity here is that this is a two-sided market. This is a business where smaller advertisers are going to go to the trade desk to reach all kinds of different advertising platforms. It's very difficult to break into that business unless you're a company like Amazon. I think Amazon has its own challenges in retail because they're just squeezing more and more out of their retail partners. Is that going to put them in a little bit of a tough position? I think that could be the case long term. The trade desk is more of kind of a neutral territory. That's what I like about their positioning. So they have lost a little bit of market share over the past few quarters, maybe the past few years as Amazon has grown, as companies like Walmart have grown. But I do think this is going to be a valuable place in the market, and digital advertising is only going to grow in the future. So just that basic thesis is what I'm looking at with the trade desk. Now, I think there are things to worry about. That slowing growth rate, it's not really something that I like. The fact that customers have complained about some of their product updates, do they not know enough about their customers and what their customer needs are? Those are the reasons that I haven't bought the stock. But we are getting to the point from a valuation standpoint that I think the reward potentially outweighs the risks that we could be taking with the stock. So that's why it's on my watch list for 2026. Like I said, have not bought shares yet, but this is one that I may start dollar cost averaging into. Next one is a relatively new company on public markets. That is Figure Technology Solutions. This is a lending company. It's also kind of like a market maker, but they're using blockchain technology. So one of those companies that could disrupt some of the status quo in finance. That's what I think is really interesting. We don't have a ton of valuation information on them because, like I said, they are relatively new to public markets, but they do have a net cash balance on their balance sheet. The enterprise value is just $7.1 billion. Enterprise value to sales on a trailing basis is almost 20. So that's pretty high. Not at the point where they're real profitable. So 135 PE ratio, even on a forward basis, you got about a 50 PE ratio. But what I'm looking for here is the opportunity. And what they're doing right now is primarily HELOC loans. So this is something I've called Trojan horse investing in the past. So a company goes in, says, hey, you know, what's an area of the market? There's maybe an opportunity to give a little bit better product that maybe most banks don't want to get into. HELOC loans would be one of these. They also have crypto-backed loans. Again, this is the kind of thing that a lot of banks don't necessarily want to offer loans for crypto-backed assets. But I think the real opportunity is Figure moving into new markets where they could play a disruptive role by being a little bit more efficient and more transparent than a lot of their competitors. They announced recently, this is November 17th, that they have registered to offer tradable blockchain native equity securities. So think about how big the equities market is. Now, if you move that to the blockchain, that's where the opportunity is. Now you pull out some of the intermediaries, make some of that trading a little bit more transparent, but those revenue sources, instead of going to companies like Citadel, they're going to go to companies like Figure. So that's the opportunity to disrupt the market. They also have a stablecoin that generates yield. So that's an innovative way to bring out stablecoins. You do have something like the USDC stablecoin. If you keep that on Coinbase, you're going to be able to generate a yield, but it doesn't natively generate yield. So this could be a new way to think about banking. Instead of going to a bank and having somebody else's deposits actually given to you as a loan that increases a bunch of risks in the financial ecosystem, you could democratize financing with something like HELOC loans and actually have other people finance that. So generate yield as an investor, crypto-backed loans I mentioned, Figure Exchange, and you could potentially hold custody of those assets as well in your own digital wallet. All of these innovative, potentially disruptive solutions. Again, Figure is not the kind of company that's going to be no risk. It's going to be far less established than the trade desk, but that's the disruptive opportunity. And when you look at a market cap of under $8 billion, that's what's compelling for Figure. They also are generating revenue. This is not a purely speculative company. They're generating an operating profit, $101 million over the trailing 12 months. So can that compound at 20, 30, 40% over the next 5 or 10 years? That could be the case with Figure. And I like companies that are playing from the offensive That's what I see with them in finance and things like exchanges. A lot of opportunity there. Doesn't mean they're going to be a guaranteed winner, but that's why it's on my watch list, not yet in my portfolio. Another one you may be a little bit more familiar with is Rocket Lab. Again, another one I've watched for quite a while, but haven't been able to get to the point where I wanted to buy shares. Now that means that I've missed out on a huge run up here. Look at that, 700, 800%, depending on when you bought from a little over a year ago in 2024. But shares have pulled back. So look at this drawdown here, almost 40% drawdown from its peak recently. So that's where things become a little bit more compelling because Rocket Lab is a much more mature company today than it was a year ago. Look at this, a $23 billion market cap. Enterprise value to sales is 40. So again, very, very highly valued. And this is a company that is making hardware. So there's real marginal costs with what they're doing and not profitable. So this price to earnings multiple on both a trailing basis and a forward basis is going to be negative. But you look at the trailing 12-month numbers and things are improving. So the growth rate is picking up. And the other thing, if you look at the bottom there, losses aren't going up at the same commensurate rate. That's one of the things I look about with some of these a little bit more speculative companies still losing money, still investing a ton of money in the future, is are they losing money to gain revenue, to grow revenue? And if your losses are growing at the same rate that your revenue is growing, that tells me that something is wrong with your income statement, with your financials. What you want to be seeing is operating leverage in the business. We're not seeing that leverage get to the point where Rocket Lab is profitable yet, but that's at least on the horizon. And the way that they're going to increase their opportunities and their operating leverage is increase with what's in blue here, the launch vehicle build rate, and also the vehicles launched. So you can see that this rate continues to go up. That's going to give you more operating leverage on your R&D, on your capital expenditures, on everything that you're doing in the business. So why haven't I bought shares yet? Well, this is one of the reasons. Their backlog not actually increasing all that much over the past year. Now, there's a number of reasons for that. They have launched more. They have done more launches, so you're pulling some of that out of the backlog. The launch timeline has also compressed in a lot of these, so maybe not a huge concern, but you look at that and then the valuation, and it's just been too, and I just haven't seen the upside in their operations quite yet. So again, on my watch list, and we'll see what happens with the stock price. This is one of those where the stock could drop dramatically. I would not be shocked. Maybe we don't get back to the $4 or $5 per share range, but don't be shocked if the stock drops another 50, 75%. If the market takes a turn for the worst in late 2025 or into 2026, already we've seen a big pullback in the stock. But if you go back to even 2022, shares of some of these more speculative names were down 80, 90, 95%. Rocket Lab could fall in that territory. That's when I want to be a buyer. This is not the same speculative company it was in 2024, much more mature business, but I want to buy that mature business at a really attractive price. So we'll see if we get there in 2026 on my watch list. But like I said, not yet in my portfolio. Now, just a reminder, if you want more from me, check out Asymmetric Investing. There's a link on the screen and a link in the show notes. That's my newsletter that I am covering everything that I'm doing investing, including my buys that will go out December 1st. So love to have you as part of that community, either on the free side or there is a premium version. That's where you get my full portfolio and all of my buys every month. I'm also doing an AMA early in December to just try to answer everybody's questions about what's going on in the portfolio. I already got some great questions in for that. And then also check out Fiscal AI. If you like what you see here, you're going to get 30% on all of their plans, but that's only for the next couple of days. That sale ends December 1st. So you got to hop on that, fiscal.ai/ASYM. Stock number 4, one that I have been watching for a while, and I love the pullback that we see here. Let's go to this drawdown from recent highs, 26%. That's what's Garmin is down in just the past couple of months. But you can see that this has been a phenomenal stock over the past 5 years. And you can see that this has been actually a pretty volatile stock over the past 5 years. If you hit the low in 2022, the gains were over 200% for a period of time. That's fallen a little bit, but that's giving us a much more attractive valuation. I'll get to some of their financials in a second, but this is one that I have not bought because the valuation just hasn't been all that good. We have an enterprise value, about $33 billion, price to earnings multiple, 24. Okay, that's okay, but we're only growing at about 12%. So that's maybe a little bit of a steep price. Same thing if you look at a price to earnings multiple of 23 on a forward basis. So not the cheapest stock, but I'll get to why I think the opportunity is to just continue compounding this revenue growth in double digits. That's why if this stock continues to fall, if we can start buying shares at a price to earnings multiple of 18, 16, even like 14, 15, that would be a real opportunity for a company like Garmin. Here's one of the simple ways to think about it. Apple tried to kill Garmin's business with the Apple Watch, with putting maps on iPhones and devices. They basically destroyed a lot of the things that people thought people were going to be buying Garmin devices for, but it didn't work. Garmin still survived. I wear a Garmin watch every day because it's the best watch out there. We're even looking at the kids version for my oldest child because you can track their location, send them text messages and things like that, but you don't have all of the distractions that you get from some of the Apple-like devices and things like that. I also think the real opportunity is going to be in more connected health. Get to some of those opportunities in just a second, but I think this valuation is starting to be a little bit more attractive, especially when you look at the compounding in their business. I showed this earlier. This is what I think you need to understand if you're looking at Garmin is they have many different businesses. You may think about their Garmin watches like I'm wearing when you think about Garmin, but that's really only a portion of their business. The fitness revenue, $2.1 billion. Outdoor is going to be the other piece. A similar size business, about $2.1 billion. But aviation, which is in purple right here, 9% compounded annual growth rate. They're a dominant player in aviation for small aircraft. You get into a small aircraft, I was in one of these a few years ago. There's just Garmin devices all over the place. Same thing in the marine market, $1.1 billion in the marine market, and they are a dominant player in that segment of the market. So some really good niche businesses, also auto OEMs, are working with Garmin as well to pull some of their data in. $670 million over the past 12 months. That is growing pretty significantly. Now, what I've been really impressed by with Garmin over the past decade is steady revenue growth. That's what's in blue here. You can see compound annual growth rate, about 10%, not a super high growth stock. That's why that price is going to be really important if you're buying shares of Garmin. But their net income continues to improve. That's a higher compound annual growth rate. So you're getting some operating leverage in their business. And look at these margins. Margins of almost 60% for their products. This is a high price product. It is a premium product. So those are the things that we absolutely want to see with Garmin. Now, where's the upside? But a couple of things I want to highlight if you're looking at Garmin. One is moving into the kids market. This is the Bounce. They now have a Bounce 2 that's $300, but this is a pretty compelling product, relatively simple. You're going to be able to send messages and things like that. So again, expanding the market into a new category of users. But the other thing is adding features to these watches that are extremely expensive. The Phoenix line can be over $1,000 per watch. But now if you have an emergency, you can send a message via satellite. So they're moving some of those capabilities that are currently on your phone to your wrist. Does this become the place where you're starting to communicate and collect more data? That's where I think the opportunity is. And that's where something like a partnership with King's College in London, where they're going to be able to use some of the data, biometric data for digital health research. I think this is just the start of this. I'm collecting all kinds of information on my watch about my heart rate, about my oxygen level. That data doesn't go anywhere. So that's the kind of thing where as health platforms become more digital, maybe it's a company like Hims & Hers, another company that I own. Maybe this information feeds into them, and then we combine it with something like my labs. They're going to be able to tell more over time about what's going on with my health. I think this is a natural place to be collecting more information about people, to be able to communicate more. Garmin's starting to move in that direction. I think things like artificial intelligence is going to be a real growth driver for them because of the information that they're able to use, and also maybe how we're able to use it in the future. So maybe you're able to communicate via satellites with an artificial intelligence tool to get directions or things like that if you're using your Garmin watch. I think it just continues to expand the market, increases the price point that they can offer. Like I said, this is not a company that's going to be growing 30-40% per year, but if you can get Garmin at the right price, I think it's really attractive because it's very well positioned for some of these markets where more data is going to be more valuable. So healthcare is going to be one of those. Think about children, pregnancy, lots of opportunities for Garmin to grow. So on my watch list, but like I said, not yet in the portfolio. The final one is Figma. Figma collaboration tool went public earlier this year and the stock absolutely went crazy. I don't think we're even back to the IPO price, but remember when Adobe tried to buy them for $20 billion? They're now trading for less than $20 billion. So at least Adobe thought they were worth that. And now you can buy it in public markets for less than that. Now, here's the challenge with Figma. Their financials don't yet show a company that we should fully believe that this is going to be a value play. They're growing nicely, compound annual growth rate, 45%. This is a relatively new public company, like I said, so you're not going to get a ton of data about their 5 or 10 year financials like you would with some companies. So they're growing, but they're also losing money. That's the real challenge with Figma. That said, if you're able to buy a company that can be a platform for design, a platform for artificial intelligence, the connective tissue between everybody from designers who are doing logos to people who are building technology tools, that could be a really valuable place long term. So is it worth 20 times sales? That's where I get a little bit uneasy about buying a company like Figma. But these platform companies are what end up being really valuable long term, and maybe paying a high price will be worth it. So this is one I'm going to keep a really close eye on their earnings reports over the next few quarters. Do they continue to gain momentum? Because if you look at their KPIs, so this is their net dollar retention rate is in blue, 131%. So the average customer is spending 131% more. So the average customer is spending 31% more each year on Figma subscriptions. Maybe that's because there's more people that they have in the ecosystem, but that's a good sign. That's exactly what you want to see from a software company. Number of paid customers over $10,000 annual recurring revenue. That's in purple here now, 12,910, up almost 40%. And then spending over 100,000 in annual recurring revenue. There's now almost 1,300 of those organizations. So those are moving in the right directions, telling you the operating leverage is working in the business. The challenge that I have with Figma is just the valuation. And that valuation was even crazier just a few months ago, starting to come back to the point where I could see this company living up to that potential and even exceeding it. So I don't know if I want to pay $35 per share, but if we get it for $20 per share, $15 per share, that sounds crazy. Remember, $35 a share sounded crazy with Figma even just a few months ago. So these are the kind of companies that are on my watch list. Some of them I'm a little bit closer to buying than I am others, but don't be surprised if these end up in the asymmetric portfolio sometime in 2026. Like I said, if you want to see everything I buy there, check out asymmetric-investing.com. Unless things go absolutely crazy, 2025 will be the second full year of that portfolio. It will also be the second year that I will have beaten the market. So if you want to beat the market too, love to have you as a member of that community. And like I said, I'm going to be doing an AMA for subscribers early in December. So check out the newsletter if you want more updates on that. And check out fiscal.ai/ASYM. It's one of those products I just continue to use more and more every day. So this is the time to get it if you're looking at it. Thanks for watching, everybody. We'll see you here next time.